Hello and welcome to Bondcast, and I'm joined today by our global market specialists, Giovanni, Zanni and Kevin Cummins. We've got two of our economists on this week, which feels very apt in a week of central bank meetings. So I think that will be the focus of our discussion, unsurprisingly, this week. So let's get straight into it. Kevin, I'll start with you in the Fed. Let's just go through sort of in chronological order. We'll start with you with the Fed. Maybe it's easiest if you just run through, I guess, your key takeaways from the meeting, how this, how it changes or doesn't change your forecast for the months ahead for the rate path, and what your updated thoughts are following last night's meeting.
Yeah, sure. Well, thanks for having me. It was a pretty interesting meeting overall. I mean, they really didn't say all that much new in their statement. They made a few tweaks to the current conditions paragraph like they typically do, just to kind of mark to market where things are. But outside of that, I think, when the statement was initially released at 2 p.m., the question was whether or not they were going to change their future policy guidance. We were of the mindset that they were going to leave it intact towards an easing bias. And, but we warned that if they were to change it, like there's been this increasing number of Fed officials that have started to kind of feel like, I think, given the upside risk to inflation against this backdrop that they're in the midst of, there was the risk that they wanted to, at least some of the hawks wanted to start to, warn and have a more balanced approach to future policy. We didn't think they'd take it that far in the policy statement, and we were correct in that they kept the language with regard to future policy fully intact. That being said, there were a few hawks who have previously suggested that they'd be more comfortable with a kind of a two-sided risk approach to future policy that dissented to that specific clause in the statement. So not only did you have a dissent in Fed Governor Mirren, who favored lowering rates by 25 basis points, but in the opposite direction, you had three regional hawks who have very much gone out and talked about this in that they wanted to be more two-sided, formally dissent against that line remaining in the statement the way it was drafted in March and carried over to yesterday's statement. So that was a new little wrinkle that we learned there, that there was this formal dissent. But I think from the perspective of really learning that much, given the fact that Hammock, Kashkari, and Logan all have hawkish leanings, and a bunch of them have already kind of suggested this in their Fed speak over the intermeeting period. It's not too surprising and really much new news there. That is something that Powell discussed in his press conference. And he even went as far as saying, I think the language is it could, conceivably come as soon as the next meeting, a change to that, which I think, I have a little bit of hard time thinking that's going to be the case. Obviously, the ducks have been aligned now for former Governor Warsh to step in now as the new Fed chair when Chair Powell's term ends on May 15th. So I don't think he'd be on board with having switched that language. We'll see. I mean, maybe we'll get a lot different language entirely once he comes on board. But, that whether or not that remains to be seen, in 48 days from now when the Fed meets again. Outside of that, the statement was very much a carbon copy of what we saw last time around. And then, of course, the big question for the presser was whether or not his future plans, whether or not he's going to stay on as a governor. He said, in fact, he started off his prepared remarks that he began the press conference with, saying that he is indeed going to be returning and staying on at the Fed for what sounds like an indefinite period of time that he's going to determine. So for a period of time, he's going to remain a governor. Of course, his term as a governor doesn't end until January 2028. I think, he's watching for the remaining steps, I think he talked about with regard to the DOJ's decision to pull back and close the criminal investigation. So, how long he's there, we'll see. A lot of the conversation in the press conference was, is this something that it could be perceived as being political? He threw some cold water on that idea. And said, no, I'm more concerned about what the Fed has gone under the last few months from the administration, that he wants to see the transition and he wants to feel that the Fed is, in a better place than it is right now, given the heavy hand that the administration has pushed towards lower rates. So, it's anybody's guess as to when he sticks around and eventually rides off into retirement. I think the big question, is does this delay any action from the Fed? And it certainly adds risk to our forecast. We in our forecast have the Fed with renewed easing in the fourth quarter. Of course, there's a few meetings ahead of that. Like I said, the next one being in June, and then July and September, and October, which we have a 25 basis point softly penciled in cut. And I don't really think the fact that Powell's sticking around changes that forecast very much. The timing is a little bit tricky, but he was pretty clear that he's not going to be a thorn in the new chair's side. He even went on to say how he understands being a chair and trying to drive a consensus view and getting, a group together about the expectation for policy. It can be challenging, and that, he's supportive where he can be. He'll be supportive of the new president and chair. So, I think our reasoning for the fact that we have renewed easing later this year sort of leans more on the outlook for the economy rather than what we think the Fed potentially will do based on what they're saying currently. They're obviously very, and correctly so, concerned about the spike that we've seen from higher energy prices with regard to inflation. But in our forecasts, after what's likely to be pretty challenging to our view on the Fed in the next couple of months, the numbers are going to be pretty hard to swallow. In the near term, we do have inflation picking up closer to about 4.5% on a year-over-year basis. So those numbers are not going to be very supportive of the Fed renewed cuts that we have, but we do expect to see better progress in the back half of the year. If you look at things like 3-month and 6-month annualized rates of change, you do start to move back towards the Fed's 2% objective. And I think that's something that incoming Fed Chair Warsh will be emphasizing, that we've kind of turned the corner after what is likely to be some pretty eye-popping numbers that he's going to be faced with early in his chairmanship. But then the numbers do start to become more constructive in the back half of the year, moving, like if you look at the 3-month annualized rate, in the autumn, that's going to be right around 2% or so, at least according to our forecast for the core PCE price index on an annualized basis. As will the 6-month, they'll be more along the lines of sub 3%, closer to 2.5%, and getting all the way down closer to 2% by year ends. Those year-over-year numbers, unfortunately, won't make all that impressive progress for a while. In our forecast, we don't have them getting below 3% till actually December, at the December meeting. But the Fed will be looking forward, I think, based on what we've heard from Warsh in his testimony last week, that I think he's going to be more concerned about what we have in our forecast with regard to the unemployment rate creeping above 4.5%. So far, the impact of higher energy prices has not had all that much of a drag on consumption. We were reminded of it in the Q1 GDP. Consumption looked pretty solid for all intents and purposes at around 1.5% at an annualized rate. So it's not really all that meaningful of a slowdown. In fact, it's a bit of a pickup relative to what we were potentially worried about in the beginning of the year, in the first 2 months of the year, but it did end the quarter on a pretty solid note. But I did want to flag that real disposable income growth is starting to, and has already contracted in February and in March. And given the spike of higher energy prices, we're likely to see a step down in consumption growth in the second quarter. So while the inflation numbers are pushing inflation up, they're also probably pulling consumption down in the near term. So that should probably start to spill over to the labor market, that we start to see the unemployment rate head up as the summer unfolds. And the Fed would probably, at least in our view, be more concerned about downside risk to the economy and to unemployment than potentially what is perhaps only going to be reflected in higher overall inflation measures with the headline PCE and the CPI. So, that sort of backdrop where the inflation numbers are making progress later in the year, but the unemployment rate is drifting higher, I think will lead to a renewed easing led by Warsh. And yesterday's decision doesn't really get in the way there that much. The exact timing of it, what particular meeting our forecasts were to be realized is difficult to say. It's so far away, but we'll see how things unfold in the coming weeks.
Perfect. Thank you, Kevin. Okay, Gia, let's move over to you. I know I said chronological order at the beginning, which so ECB before BOE isn't quite chronological order, but I think maybe the ECB was slightly more interesting, or at least gave perhaps clearer guidance than the BOE did around the policy path ahead. So why don't you run through your take from today's meeting, what stood out to you, and I guess how it has or hasn't changed your view of the policy path ahead?
Yes, I think the ECB meeting was interesting today. It started with a relatively boring and very balanced statement, the policy statement, but then it got interesting in the Q&A section, where we had Lagarde sounding quite hawkish, actually. Although my bottom line will be that I think that it's what I call a conditional hawkishness, or something that it's needed from a central bank facing a supply shock as the one we are seeing, to basically buy some time and act only if needed. But just let's go back to what we've heard from Lagarde. I mean, basically, she said that first of all, they didn't hike, but the hike was discussed at this meeting, although then they all decided unanimously to postpone the decision to June. And they did so because they realized, first of all, that second round effects were not that visible yet. And actually, there was contrasting data in terms of some surveys with firms saying that they are not expecting to have wage pressures, whereas we saw some indication of selling price pressure in some other surveys. And so let's say that the set of information was still incomplete. And then, in addition to that, the financial conditions, for example, as seen in the bank lending surveys, had become more tighten, and so that was already doing part of the job for the ECB in a sense. So basically what they decided is that because they had the credibility, because they were more or less neutral, that there was no urgency to act, and that June was the right moment to reassess the whole situation. Of course, what she also gave with this hawkish kind of sense is that not the inevitability, but the likelihood of a rate hike happening in June if nothing else changes. And I think that's quite important to me, this nothing else changes, because she mentioned things like dynamics in terms of growth worse than expected. So the downside risk on growth are larger than expected. And so this implication for second round effects becomes less automatic if you have a growth problem that clearly do not push the workers to ask for increasing wages, etc., etc. And then, of course, the big question is about the conflict in Iran, because that's what can really change the dynamics and the decision of the ECB between now and June. So that's why I mentioned this conditional hawkishness. The tightening, in a sense, is going to happen in June and later as well. The ECB didn't give clues that they were, opposing market expectation of, let's say, 2 or 3 hikes. But this is conditional to what happens to energy prices. And there were actually, ECB sources after the meeting suggesting precisely that a rate hike will be difficult not to implement unless there is movement in energy prices before the date. So, it really depends on what you expect in terms of this conflict dynamics, how fast it can be resolved. And of course, then this other element that I was mentioning, this kind of pass-through second round effects that is linked to what's happening to activity and suggests that maybe even on that case, there could be questions on this rate hike. So just to conclude, I would say that definitely a rate hike from today's viewpoint is more likely than not. But this is maybe also what we've seen already, like only a few weeks ago, when there was a market expectation of 100% of a hike in April, and then it didn't materialize. So I think we're still in this situation where there is high uncertainty linked to things that are not typically related to what a monetary policy should react to. But we have this uncertainty. The ECB bought some time, and the optionality, I think, is still there. But we have to assume that if nothing else changes, then we will have this rate hike in June.
Amazing. Thank you, Gio. Okay, perhaps I'll just conclude by running through the Bank of England, who also met today or published their decision today to finish off this kind of trio of central banks this week. As was widely expected, the Bank of England kept rates on hold, so that's at 3 3/4, 3.75%. The vote was 8-1, which was in line with consensus, a little bit more hawkish than we were expecting. So there was one dissenter for a rate hike, which was Chief Economist Hugh Pearl. It was one of the Bank of England's quarterly monetary policy report meetings, so we got an updated set of projections, although they looked a little bit different this time around than what we're sort of accustomed to. So I would say the overall sort of messaging from the guidance was unchanged, but of course it looked a bit different from last meeting in that the guidance was now centred around these 3 scenarios that they published as part of the monetary policy report. Scenario B, which was kind of pitched as the central scenario for most, I suppose, had a relatively benign feel to it in that inflation gets back to target over a 2-year horizon with only kind of sub-trend growth and moderately higher unemployment, and a path for bank rate that's not particularly high. I guess when you compare that to current market pricing, it had some rate hikes in, but certainly not as many as the market was pricing. I think whilst the guidance didn't change, I don't think the scenarios offered us much more clarity necessarily on the future path of bank rate, because of course within the scenarios there were different members who placed different weights on each one, and even within that it wasn't obvious exactly who was favouring which scenario over another. So I don't think we learned a lot of new information today, and I think that there was enough within it, within the scenario analysis, within the projections, that actually you could justify whatever your prior was. So I don't think that there was much in there to change any market participants' kind of prior view. Now, you might have looked at the market reaction. We're recording this at sort of 4 p.m. on the Thursday, so we're a couple of hours off, and markets have rallied, I would say 2 years, probably about 7 or 8 basis points at the time of recording this down, i.e. yields have fallen. So you might look at that and think that there was a kind of dovish slant to the meeting, but I think actually that was just taking out some of yesterday's overly hawkish move rather than new kind of meaningfully dovish information included in today's minutes. There were some dovish parts to it. I guess a couple of things that I would highlight would be that within the 3 scenarios, we had A, B, and C. A and B were really quite close together in terms of the outcomes, and like I say, quite benign scenarios. And so perhaps the fact that they were very close together, and C, the more hawkish scenario, being some distance apart, gives you a sense of where the kind of centre of gravity of the views of the committee, or where the centre of gravity of the likely path ahead for inflation, growth, bank rate, etc. is. The fact that scenario B, the central scenario, was, you did get back to target inflation on the 2-year horizon, so 2% inflation, with a more dovish bank rate path than is currently being priced into market. So it had a kind of peak in bank rate at 4.2%, which is a good at least sort of 20 basis points away from the peak that the market is pricing. I think that adds a dovish tilt. I think the fact that the BOE still see quite slow and quite minimal, to be fair, contributions to inflation from the indirect effects of this energy shock. So they kind of laid out quite clearly a monthly profile for the contribution to inflation from these indirect effects. And And that only starts to pick up speed really at the back end of the summer. So still in June and July, they only have a kind of 0.1 percentage point contribution to inflation from these kind of second round effects. And only in September does it pick up to around 0.4%. So really quite minimal, I would say, so far estimations of the way that they expect these indirect effects to play out. Against that, you had Governor Bailey in the press conference who appeared to endorse current market pricing. He said he didn't think the interest rate curve was in the wrong place, which is somewhat interesting when you consider that at 12 p.m. at the start of, just prior to the Bank of England releasing its rate decision, the market was pricing in 70 basis points of tightening through the rest of 2026, which is quite a departure from his comments just a few weeks ago when he said that markets were getting ahead of themselves by pricing rate rises. And it's also quite different to what was kind of included in their stylized scenario B, which had inflation. The bank rate rises that were included in scenario B were considered sufficient to get inflation back to target. And so, he said that he didn't think the interest rate curve was pricing in too much tightening because there is a distribution of outcomes, which is, of course, a fair point. But implicitly, then you're sort of, I think, attaching a greater probability to scenario 3 than the minutes would suggest he was doing, or the minutes would suggest the kind of median voter on the committee was doing. And then he sort of complicated that picture even further as well with regard to market pricing in the scenarios by saying that felt like energy futures curves in terms of what they were pricing for the path of energy prices going forwards was optimistic, which is interesting because that was the path broadly that scenarios A and B, which he seemed to broadly subscribe to, were based on. So some sort of conflicting information that pushes against that sort of perhaps initial dovish read when you think that the median voter on the committee still appeared to be sort of leaning between scenarios A and B and in the more dovish camp rather than leaning towards B and C and perhaps voting for a hike anytime soon. But all in, I think my takeaway really would be that the balance of all of that information didn't do a lot really to change our, or probably most market participants' base case. I think market pricing still looks a little bit hawkish versus our base case. So we still have 2 hikes as our central scenario, one in Q4 of this year, one in Q1 of 2027. Market pricing looks more hawkish in terms of the timing rather than that overall delivery of tightening that they're expecting. The market seems quite convinced that hikes are coming sooner rather than later, which I'm less sure of. And I think today's minutes just kind of reinforce that view. I think if we're thinking about getting rate hikes as soon as June or perhaps even July from the Bank of England, it's not obvious to me who of those doves that voted to hold rates today, who will be changing their view over the next 6 weeks in quite a meaningful way to then be voting for a rate hike. Of course, you can have hawks at one side of the committee. You can have people like Megan Green, you can have Catherine Mann, who talked about the fact that, we might need rate rises and sounded quite hawkish in their paragraphs in the minutes. But it's sort of the median voter that matters. And the median voter, to me, still sounded somewhat dovish, or certainly not in a rush to raise rates at the next meeting. So that market pricing in terms of the timing of rate hikes still looks a little bit hawkish. The interesting thing for me, though, we've been on the road this last week, just in London, but we've seen a number of fast money and real money accounts. And perhaps we'll talk a bit more in detail next week about what the key takeaways from those meetings were. But one of the things that really stood out to me was that there was a real dovish consensus on the BOE. Our view that they could hike twice was definitely at the very much more hawkish end of the views that we heard. And that's not to say that no one agreed with us, but those that did were definitely in the minority. And so there appears to be a real disconnect between the client conversations that we've been having over the last week and the consensus that's arisen out of those and what the market has been pricing, this consistently more hawkish outcomes. It's an open question, I think, how much of market pricing actually reflects, underlying assumptions around the bank rate path and how much of it is a reflection of, market dynamics, positioning, etc., etc. Yeah, I think that's it. All a very long-winded way of saying that we didn't learn much new today, I don't think. It painted a much clearer picture about the path ahead for the Bank of England. But ultimately, we hold our call. It puts us, I think, at the more hawkish end of expectations, albeit not more hawkish compared to bank rate pricing. That's probably enough for today. A bit of a monologue from each of us, but I think in a week of big, important central bank meetings, it's probably worthwhile. And there's plenty. Next week, we've got the jobs data, we've got local elections in the UK, so I think we can catch up on all of that on this podcast next week. Thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out our other NatWest podcasts, Currency Exchange and Trade Links. Thanks, see you next week.